this is forexbrokers.net, and we continue the technical analysis videos explaining the concepts presented on the articles part of this Trading Academy. This time we discuss the support and resistance in technical analysis, one of the earliest concepts in technical analysis belonging to classic technical analysis, the US school of technical analysis, when the stock market was introduced for the first time and traders started to note certain patterns and certain reactions that prices had on specific levels. Support and resistance is an interchangeable concept in the sense that by the time that the market reaches support, or this is resistance, or resistance, support, if resistance is being broken as the price here breaks the resistance changes place and becomes support. So on a retest, this is support. It is not wise to be on the short side anymore as the level becomes support, and then the market breaks here lower as well into previous area that proved to be support. Support here broken becomes resistance, and so on and so forth, all the way until the right of the chart. This is the Great Britain Pound US dollar, the monthly chart. It shows the price action since 1995 all the way to this 2019, and it proves very well the concept of a classic support and resistance levels. Classic support and resistance levels form on the horizontal, and the bigger the time frame, the stronger and the more powerful the levels are. Imagine that here on the monthly chart it took four or five full trading months for the price to actually bounce from the support. So there is no excuse for the trader to miss this kind of levels. And here as well, almost 2 months, here 3 or 4 months, not to mention here almost a year or more than a year, 21 months until the price eventually put in a triple top against resistance before moving lower, triple bottom against support before moving higher. Support and resistance have a more powerful interpretation if they form reversal patterns if the price forms reversal patterns at those levels. For instance, here on the support level in the first example, the market formed a triangle as a reversal pattern. This is a typical Elliott waves pattern, normally a double combination that you will find on the Elliott waves articles here on the Trading Academy. And by the time that the triangle broke higher, it means that the corrective wave ended on support, and then the market simply bounced. So this kind of price action only comes to reinforce the strength given by support. And then the market comes here, puts a double bottom on support, a double top on resistance. We already covered double tops and double bottoms. The W and the M letters help identifying them and also using the measure moves. Here on the fourth example, the next test of this support doesn't show any kind of reversal pattern, so I would ignore this one when it comes to trading. But this is a rising wedge forming against market resistance, a very powerful signal. It was very difficult to break it earlier. Forming a wedge against this resistance is a bearish sign and is not wise to be on the long side. Even if you don't go short, at least don't stay on the long side. Wait for the 2 to 4 trend line to be broken. Apply the rules of a rising wedge as we discussed in the previous analysis, and you should be okay. No reversal pattern on this support level. As a consequence, the price broke lower. This was the Brexit vote in the United Kingdom in June 2016. After the Brexit vote, this was the flash crash that happened in the Asian session. The market reversed, put in a double top against previous support turned into resistance, and therefore it was simply unwise for being on the long side against resistance, at least when it comes to the Great Britain pound US dollar. So this is how support and resistance change levels. Support becomes resistance, resistance becomes support, and if there is a reversal pattern against these levels, it reinforces the strength of it. This is the euro and the US dollar on the monthly chart, and it explained very well the concept of dynamic support and resistance. Dynamic support and resistance follows the price action. For instance, for a trend line, all you need is 2 points. This is 1 point, 2 points, and then you drag the trend line on the right side. Every time that the market comes to this trend line, it meets dynamic resistance. So even if the price falls and reaches the trend line on a lower level, it is still a resistance because the trend line followed the price. Dynamic resistance is much more powerful than horizontal one. This is like a rule of thumb if you want. Also, when the price reaches 2 or more horizontal or dynamic support and resistance levels, that area is called the confluence area. It's a very difficult area to break. In this case, if you drag the trend line from connecting the two highs here with this one here, and this is a confluence area, a very interesting area, because the euro US dollar broke lower here. It recovered after President Macron was elected in France, and then it didn't stop all the way to this confluence area. It formed a triangle for a few months here, 3 or 4 months, and for 3 or 4 months the euro US dollar actually was struggling to break a confluence area. Traders used to the support and resistance concepts knew that this is unlikely for the price to break, and even if you have some doubts, you simply wait to see the direction that the triangle breaks. If it breaks lower, then just follow the triangle, and that should be an easy way to profit from the market. To finish, still the euro US dollar, dynamic support and resistance, but also confluence areas given by the Fibonacci ratios. The Fibonacci ratios, the 23.6, 38.2, 61.8, 50% is not a Fibonacci ratio, by the way, but is a level that the market reacts at very often. Have a look here. To the upside, or to the downside, if you connect these 2 points on the euro US dollar on the monthly chart, so we have this info here from 1985 and this one here from 2001. Simply dragging the trend line on the right side, we find out what? We find out dynamic support this time, which is powerful on the monthly chart. But if we measure, if we take a Fibonacci ratio retracement level and we measure the distance from highs to lows and to the absolute lows, and then we check a bit the Fibonacci ratios, we see that not only that the price formed or found support at the dynamic support, but also at the classic support here. Not only that the price when it bounced found dynamic resistance, but also as the classic resistance here. It only comes again to reinforce the levels and to put support and resistance into a different perspective. These levels here are confirmed by the projection of the trend line. If you project the trend line from the previous market swings, you see that the market actually reacted 4 times of it, giving a plus to the analysis, in the sense that if the angle was appropriate enough to give here dynamic resistance, it should work on dynamic support as well. It offered for 4 times dynamic resistance, it should offer for at least 2 or 3 times dynamic support. So far it did. This is how you use support and resistance. This is how you use classic support and resistance, dynamic support and resistance. And whenever you are able to find confluence areas, focus on them because the price has a hard time breaking them. Bye bye.